will be today's event will be witnessed by 368 people. So those who will join live, they can see that, or else those who are missing this event, they will get the recording. However, those who are missing the event, they may not get the chance to download this document. So those who are joining live, they can download the documents from the handouts section. This is one of our finest finding in year 2021. So those who are associated with smart finance, so they knew every year we come with new innovations in the trend forecast with a specific mathematical way to analyze the things. And this is one of our innovations in year 2021. And before going to this particular event, I will again tell you this particular method is very simple method and it has a reward or a strike rate of 80% plus success, which is very, very promising success. You can use it for intraday, you can use it for positional trades, short-term positional trades, less than 10-15 days period, and you will experience the similar success, 80% plus success it will give you. You can use it for all instruments, commodity, stocks, futures, currencies, in all segment you can utilize it. It's a very promising method, and this particular method in the last corn course, so WD Gann has given a different you can say different commodities. He used to give certain courses. In the last corn course what he has given, in that he has mentioned, only he has mentioned, using the universal constant also you can do a great trend forecast. He said the universal constants having a great role in our life. They are integral part of our life. So they are also integral part of our thinking. So anything which is integral part of our thinking can be utilized for the trend forecast. So he has just mentioned it. However, he said someone should take this research forward. So we have done this research in smart finance. So we have come with the conclusion how to use this, and we are also working on this. Some more area we need to touch in this. So some more area, some more new constants we have to touch in this particular segment. So far what we have achieved, it's promising result you can get. So now coming to this particular subject. So here we are going to learn about the trend forecast using the natural constant. So here all these natural constants, whenever I say, there are different kind of natural constants we are playing. One is phi. So this is one of the Fibonacci ratio, all of you will be knowing. 1 divided by 0.618, which is known as 1.618, is phi. So phi mathematically written 1 0 and 1 stroke. So phi. Square root of 2 also is a very important constant. Square root of 10 is also a very important constant. Pi is being utilized versatile way to know the radius of a circle, the area of a circle. Pi is one of the finest innovation of Indian mathematics or Vedic mathematics. Mostly rely on this pi, and pi have a great role. This pi can predict the distance between various planetary objects, like from your solar to sun to earth or anything. So if you know the light velocities, so that process we calculate the distance between different planets to our earth using the pi. And the next constant is E, epsilon. So this particular constant also versatile use it is having. From your parabolic path, the you can say all the missiles what we are striking and all your all your, you can say, satellite movements, everything is being, this E is being utilized. So E is being utilized in physics, it is being utilized in chemistry. It is a versatile term in the mathematics. So what, we are not going to go deep into this constants. So these constants, as per the WD Gann, he said these constants are present in all your mathematical science, physics science, or even your medical science. Many places you are using it, and using these constants, we do lot of mathematical calculations using the distance between different planets and everything. So since they are constants but having a great role in your life, so they'll also have a role in your thinking. So once this constant have a role in your thinking, so they can also do a forecasting. So when they sit in your thinking, what happens, they can also do some forecasting. So here time travel, so all time travel thing is nothing but forecasting. So forecasting nothing but to travel with the time, to travel forward, it is forecasting the forward event which has not happened. So that is called your forecasting. So these five constants I am going to utilize for my predictions. So before I go into these calculations, once again I will tell you, we have already released the web edition of this particular calculations. So you can visit our website smartfinancing.com. In the calculator segment, the first calculator, if you use this, you can just open. So it requires only three values to predict the entire price movement for the day. The most beautiful part of this thing is this particular method only requires three variables to predict the entire price movement of the day. The first value, it requires the opening price value, that particular day where the price is opening. So number of days, so for intraday you are using 1. If you want for positional, you can increase it 2, 3, 4, 5, 6, 7, 8, 9, 10. You can increase. So intraday you will be using it 1. Then annual volatility of that instrument. So suppose if you are Nifty, what is the annual volatility value of the Nifty? You must ask me from where I will get the annual volatility. There are two ways you can use or calculate the annual volatility. One is ready-made available with the NSE site. So if you are visiting the NSE site, you just go to the NSE future, any NSE future contract. So 29 July, if you just hit here, you will get annual volatility 25.17. Though this volatility is not a correct estimate, this volatility has taken past 365 days data to project it. So this is 25.17 volatility we do not have now. Nifty has far below volatility. However, this volatility, if you do not know how to calculate volatility, you have to rely upon this volatility. Certain things like you can say commodities, you can say currencies, you will not have this volatility figure here. Or for some equity symbols, you may not have the volatility symbol here. So we have also given one more web calculator to help you to calculate this volatility. So here, once you visit this calculator, you can say calculator segment. The first calculator I am focusing on trend forecast using natural constant. So if you visit here, we are giving you one more link here. If you do not know annual volatility, please calculate here. So if you hit here, you can provide past 10 days data and you calculate the volatility. So this will be with the reference to past 10 days data, you can get this volatility, daily volatility and annual volatility. So you require the annual volatility figure. So for our calculations, we require only three inputs or three data: at which price the stock or commodity or the currency has opened, number of days. This suggests that if you are having intraday, we will be taking number of days as 1. If you want for 2-3 days, you increment the days. Annual volatility of that instrument, if it is known to you, you can add it here. If it is not known to you, then you have to calculate these things using our web calculator. So all this information, whatever you require, all information we have given in here. So now first you learn what is this particular method is, so that it will sound very logical to go into it. And this particular thing also, as I mentioned to you, this particular method we have brought into the public domain on our GAN program. Last month's WD GAN's program, complete GAN course program, the session 17 and 18 it is being taken. So many of you have joined that program, many of you have experienced this method, and the overall success rate, what I used to say, it is above 80% success it maintains. So here, how to go about this method, how we can calculate all our, or how we can make the calculations of using this constant. So what happens here, we have to use the exponential, we have to use different volatility and time period. So stock price prediction using the E or exponential function, it is known as E to the power R and T. So this is a formula already existing. Any financial instruments price prediction, if you are going to do, will be using E to the power R into T. T is nothing but time in year. So time in year, and R is nothing but rate of interest or rate of return. So here they say theoretically all price, the fair value of a stock can be estimated. Suppose if you are saying that after 3 years, what will be the price of this particular stock? So what you have to do? So now say stock is trading at 100. So I will be telling 100 multiplied with E to the power rate of interest into T. If the rate of interest is 12% or 6% or 10% per annum, so this is 10, and T is the time in year. So 3 years means it will be 3. Half a year means it will be 1 by 2. 1/4 of a year, 3 months means it will be 1/4 of a year. So like this way, time in year. So by this process, the theoretical fair value of the stock is estimated. So here they argue that the stock, whenever produce more return than its estimated value or the fair value, then it is having a higher alpha. So this is what traditionally being utilized. So I am going to exploit this particular formula. I am going to exploit this particular formula and going to accommodate all GAN constant into it and see what kind of result I am getting. So this is the traditional way. So what I am going to do here, the interest rate what they have used here, I am going to replace this interest rate with volatility. So I am going to replace interest rate with the volatility. So here volatility is going to replace the interest rate. So once the interest rate is replaced with the volatility, then next is left out time. So time I am not going to touch. For intraday, I am going to take, it is 1 divided by 365 years. So my intraday is nothing but 1 divided by 365 years. If you are going to do it for the 2 days, so 2 by 365 years. So time I am not going to touch. I am going to change the R factor, the rate of interest I am going to change with the annual volatility. So sounds logical also, because why one stock price will follow an interest rate of a country? Stock price is not binded to the interest rate. So interest rate may be 5%, 6%, 7%, whatever may be. So stock price is completely silent on the, or any commodity or stock price, they are completely silent on the interest rate. Interest rate is a entirely different scenario where your lending institutions are giving you that. So here using the interest rate, we are just getting a fair price which is convenient to us, which is only convenient to us to show some mathematical value. However, if once you change this interest rate with the volatility, it makes the real sense. Stock has this much of volatility and it can show this much of movement. So now after replacing this e to the power r into t, as I said to you, I am going to exploit this particular formula. R I have changed with the volatility, that is with the annual volatility. Time I am not going to change it here. And all these constants, whether it is phi, whether it is pi, whether it is square root of 2, everything I am multiplying with this, because these constants are having a great meaning for my calculation, because here GAN says that you must use these things for something. So how I can utilize this? So Fibonacci phi constant 1.618, I am just multiplying with this one. Volatility multiplied with this, multiplied with time, and whatever the price the stock is trading, so this stock price also will be there, and it will be multiplied with this variable, and see what kind of result we are getting. So here the stock price what I'm taking here. So if I'm going to do intraday projections, so it is non-material what happened yesterday, what happened 10 days before, or what happened 1 month before. So here it is more important that where I am opening today. So opening will be having a gap. Either it will be a gap up or gap down. It will have a gap. So opening price is factoring the gap actions. So here I am taking this price as the open price. If I take the open price and simulate these calculations with this e to the power rt into constant, natural constant, where r is volatility, t is the time in year, and constant is any of the value, either square of 2, square root of 2, square root of 10, or 1.618, then I will get some amazing result. So this I am going to do here. So now you must ask me, why this constant? As I said to you, these constants having a great meaning in our life. It is great meaning on our mathematical, physics, chemistry world, and it has a great meaning in all of these things. Just have a look on these constants. So here I'm going to take these four constants. Phi is nothing but your Fibonacci's most important constant, 1.618. So how 1.618 is being derived? 1 divided by 0.618. 0.618 is your Fibonacci death zone first ratio. The first ratio from where the retracement can, or the trend can change, 0.618. So if you take the inverse of that, 1 divided by 0.618, you get phi. So for using this phi, many technical tools have developed. Phi ellipse has developed. So using the phi constant, you say that yes, here the trend is going to get terminated. So all these things has come here. Now we are going for a square root of 2. So which is next value, which is 1.414. Why this square root of 2 is important? So in the Pythagoras theorem, it is still that the smallest triangle whenever you will draw, having 1 unit as base, 1 unit as height, then this particular diagonal will be the square root of 2. Square root of 2. So why this square root of 2 is so important for us? So when you draw 1 unit as base, 1 unit as height, this diagonal is nothing but a 45 degree trend line. So this diagonal is nothing but a slanting trend line which makes a 45 degree with the base, and your price time graph is nothing but a arrangement of times in the x-axis and arrangement of price in the y-axis. So when I say that 45 degree trend line, this is the most important trend line in your price time graph. So for that reason, so I'm just making that is the smallest trend line which can be drawn with a 1 unit of base and 1 unit of height, means 1 unit of time movement with 1 unit of price movement. If 5 rupees movement happens, 10 minute 10 rupees price movement happen, then I can say that if I join all those prices, I am going to get a trend line which is 45 degree trend line. So for that reason only, this constant also is very, very important for me, because I am not going to draw a big trend line and going to introspect on that. Now coming to the square root of 10. Square root of 10. So square root of 10, again it speaks about it is the first two-digit number. So first two-digit number post 9, 10 comes. So and using this 10, lot of innovations are there. Those who are the mathematical students, they will be knowing that the log of base 10. Why there is no base 11, 12, 13? Base e is there, where you are saying that ln of e natural logarithm, and you are saying that base 10. So this base 10, 10 is the first two-digit number in our number sequence. So these two also have a great importance for us. Then come to the pi. Pi is nothing but your 22 by 7, and it is a great innovation of India, and it is a great contribution of Indian mathematicians to the world. And this pi has a great many roles. It is nothing but it can give you the circumference of a circle 2 pi r. It can give you pi r square, the area covered by one circle. So it doesn't restrict here. Pi is a thing which can give you many views, like your solar eclipse calculations, lunar eclipse calculation, many calculations you do with the help of this pi. Not only that, nowadays most of you will be using the oximeter for knowing that oxygen saturation level of your blood. So what it does, that instrument passed specific lights, and that lights penetrates your finger, and it has a receiver in the opposite end. So you have an oximeter. So here two ends, you put your finger here. So once you put the finger, so light emits here, it hits a receptor here. So if here 10, 10 waves are going, how many waves are being getting received there, and how many red waves are being absorbed by your blood? So based on that, there is a small formula. Post the session you can explore. There is a small formula which can give you the oxygen saturation level based on this wavelength. So somebody was telling that I put a biscuit, so it was showing that oxygen saturation level is 100. Many of you would have seen that video. So that is true, because if biscuit is a porous object and all the things, all the lights passes from one end to another. If you put a metal there, instead of your finger, if you put an iron sheet, if you put a small gold sheet there, so you'll get oxygen saturation is 0. So nothing to laugh in that. So because any porous object, the light passes through that, and the receptor which is in the top end of this receptor receives most of the light objects. So using the pi, that formula also uses your pi, that formula also uses your E, because without E you cannot calculate the wavelength of light. So without pi you cannot calculate the how many wavelengths have reached. So these all physical instruments, whatever you are using till date, your mobiles, your oximeters, everything using this particular constants. So if this constant having a versatile use, then these constants have a great role in our decision process. And these constants are not small constants. They are known as universal constant. What is a local constant? What is a universal constant? The constant by mean of which all universal objects you can able to calculate. Distance between your moon and earth. Nobody is putting a tape from earth to moon and calculating. Distance between the earth and your sun, light wave you are examining and telling that yes, we are this many distance from here. So all your universal objects can be estimated, calculated by sitting on the earth using these constants. So these constants are, though it look like a very simple number, but it is a great number which has a great role. So anything having a great role in universe must impact your thought process. That is what the base of W.D. Gann's study. So he'd say that anything natural, universal has a role in your thinkings, and that thinking is known as your forecasting. So these natural constants we are going to utilize for our predictions. So how we are going to predict it? As I said to you, this particular constants we are going to do our trend forecast by exploiting that formula. What I'm going to do here, I'm just going to arrange these constants in the chronological low to high order. Low to high order. So first my phi is there, square root of 2 is there, square root of 10 is there, pi is there, exponential is there. So I'll just arrange these things into the chronological order and I'll give them their names with that. So first what I am doing here, I'm taking just the annual volatility without any constant. Say my price is on the 15,835 Nifty, annual volatility 25.81, just halfway concentration in this formula. What we are going to do here, S0 into e to the power r into t into natural constant, which I am putting as a NC, natural constant. So it is for uptrend. For downtrend, I am taking the opening price S0, I am mentioning stock price opening, e to the power minus r, then t, rate of return is nothing but the annual volatility into n into c. It is for the downtrend. So this, what I'm doing to do, I'm just arranging these things in its proper order. First, I'm not taking any natural constant. So natural constant is not present, only volatility, intraday, square root of 1. So here, so square root of 1, which is intraday, we are going to do into 1 divided by 365, because t I require in terms of year. So if intraday, 1 day will be converted to 1 divided by 365 year. So I got the first top or the first price. Next, I have to take the square root of 2. So remaining things will be same, volatility as it is. One natural constant I have added, square root of 2, which is called as my 45-degree trend line. Second, which is higher value, square root of 2 is 1.41 and all. So second value is I'm multiplying the same e to the power rt, natural constant is 1.618, which is pi. Fibonacci phi is a 1.618, is one of the most critical retracement constant. So this I am putting. Then the next value comes square root of 10. So which is higher than this. This is minor cycle. The hypercycle comes to the pi. So 2 pi r is the rotation of a circle. So here Gann study also plays a very important role. Why 2 pi r? So here Gann study says that 360 degree creates a hypercycle. So just I am borrowing few terms from the Gann study. So that says that Gann chart 360 degree creates a hypercycle or a complete rotation, a complete cyclic movement of a price. So for that reason only, I am taking 360 degrees nothing but 2 pi r. So 2 pi r. So based on my r is nothing but my volatility. So based on my volatility is already being used. Using this particular volatility, a 2 pi r rotation will be a hypercycle. So that hypercycle may be for intraday hypercycle, it may be a 2 days hypercycle, it may be a 5 days hypercycle. So Gann says that whenever one stock price or any price moved by 360 degrees, it is known as a hypercycle complete rotation. So I am using, for that reason only, I am using that circle's circumference formula 2 pi r. Here r is not my radius. What is my r? R is annual volatility. Pi is as it is 22 by 7. So using these things, once you do the calculations, you get a fantastic result in this. So I'll show you specific outcomes. As I sent to you, this particular calculations require only 3 inputs from you. Natural constants are constant, constants are not going to change. So here, first top is not using any natural constant. Second is using square root of 2. third is using 1.618 constant, fourth is using your fourth is using, so here the fourth minor top which is we are forming, so this is using, fourth is using square root of 10, fifth is using the pi, 2 pi r. 2 pi r, r is nothing but your volatility here, 2 as it is, and 2 pi r. So here we are just copying a part of Gann's concept into this because it is a gifted by Gann. Because if Gann would not have spoken about this word, we may not be in a position to break this technique also. So here the idea first flowed from the WD Gann, though we have decoded it, but the credit still goes to the WD Gann. So here, what happens? Once we give these values, it will give a perfect calculations for the intraday tops and bottom. I will tell you that what is the, so here you are seeing that today what was the volatility. This annual volatility will never change within the day. If you are taking the reference from the NSE side, whatever the annual volatility you are seeing today, it will remain same throughout the day. So what happens here? Annual volatility 25.17, we required the opening price 15,781.5, days low was 15,781. So you can say open price and days low almost same, just there is a 50 paisa difference. I am taking from the NSE side the authentic data, not cooked up data, 25.17 annual volatility. Let me put these values and see this. So here software takes in a different way. I'll explain that in after some time. So opening happened 15,781. So once the open happened, this readings you can take intraday calculation I'm doing. I am taking 25.17 as my volatility given by the NSE site. So I'm not taking the volatility from my 10 days data reference. So once I do this and calculate, so 25.17 double dot I put, so that's why it is giving this error. So I made a calculation. Just have a look here. Just have a look here. This is my first cycle, minor top crossover, hyper top. This is my first cycle, and mostly the first intraday top, second, and golden mean. These three are the consolidation zone. Once this breakout happen, this is a consolidation zone. As a trader, you need to see that yes, first top is being created. These three price points has to cross over. Once it cross over, you need to look into this minor top. This is very important. The moment this crossover happens, very quickly with very less time, in a very fraction of few minutes, you can hit this hypercycle top. So this price is very, very important for you. So minor cycle, once it gives you a crossover, immediately within few minutes you can get this hypercycle. So you got these levels today. So just compare with today's happening. What happened today? Today, this is the opening. High price is showing us 15,880. Closing happening or the last traded price it is shown here 15,880. So just compare it with our calculations here. So here 15,818, just 2 points above the minor cycle closing happened. 15,880 minor cycle, the first cycle completed. Second cycle just 4 point below it has slipped and come out. In fact, this volatility is not the true volatility because it has taken past 365 days data. Still having a impure volatility, it has achieved this result. If it could have taken a real volatility, the real time volatility, what could be the result? So suppose if you are using the our software which calculates the real time volatility, just market opens, it will calculate, and till the third cycle has not come, it will not change this value also. See, as per our calculation, what happens? So here this says that 15,871. So here 818 one cycle completes, 856 another cycle completes, 894 one cycle completes, and the reversal is happening from 15,000 880, 880, and the closing is happening 15,000, or the last traded price is happening exactly 89 paisa below the hypercycle, because here the volatility is a real time volatility which is being calculated on real time basis. As soon as market opens, it just 5 minutes after the market open, you can get this particular calculations ready. So this is what the natural constant does. So you have compared it with the Nifty. Let us go for the Bank Nifty or any other counter. Say Bank Nifty I am going for, or any other counter you can go for Bank Nifty. And this is a web tool. You can test. So test based on your convenience. So here the test based on your convenience, and almost everyone is present now. I will suggest that those who have not downloaded the document, please download it from the handout section. So handout section, we have the documents, and this particular concept we have explained in the uh, so this particular concept we have explained in our last WD complete course. So those who have joined this program, they have already learned this program. But somehow if you have missed this program, still you have the options to purchase the recordings of this program. So here, so so if you have somehow missed the program, you can complete WD course, which has happened last month, 21st June to 15th July. So 15th July. So if you have missed this program, you can buy its recording also. The recordings are available. So along with the Excel sheet and everything you can get. So in this program, the third module, session 9. So this particular concept is being taken. So those who have joined that program, they knew it very well. The document I have given. And one more announcement, we are going to have a fantastic program on futures and options, specifically option strategies, which is going to start on 9th August. It is a very long program till 13th September. English and Hindi, both the modes it will be taken. These two also having 3 modules. Each module is having 4 to 5 sub-modules. So you can say it is a complete 26 session, 26 hours, 13 sessions will be in English and Hindi. So if you want, you can join that program. So now we are going to test for the Bank Nifty, and here too, as I said to you, this required only 3 inputs: opening price, opening price. So here 34,889, 34,889. I'm going to do for the intraday. Annual volatility figure I am taking from the NSE side, 36.90. In fact, it is not the true annual volatility, 36.90. I'm going to calculate this level. So these are the levels I have calculated using the natural constant. So let us see what happened today. So here, if you just look into these price points, so you have gone high 35,155, low 34,732, 732, and it is settling at 34,959. So 34,959 it is settling. So 34,959. So just 10 to 15 points above it is settling. So here you are going for the 35,155. Your first cycle completing hypercycle at 35,111, 35,155. So here, from here only the retracement starts, 5 to 6 points, very close, near to that you will get. So retracement starts here, and you are settling just few points above that, 34,959, 34,959 you are settling. In fact, this volatility is, again I repeat, it is by taking the past 365 days data, which is not the true volatility. Now this 36.9 volatility is not present now, it is much lesser. So if you see the same thing in our software, you will get a different figure, because it is not taking that old volatility into account. It is taking the real-time volatility into account. So you can see here 34,035 155 you had a retracement, so you can say compare it here. So 155, 35, 155, hardly some second cycle of trend, it has given a crossover, just 10 point above gone. From there, third cycle it has not entered. From there it has retraced back and it is settling at what price? 35. It is last traded 34,959. Just get this 34,959. So in the, this is the just 6 point above, it is closing here, closing here. So very close near to this it is closing. So I have given you the documents on this particular subject in the handout section. You can download and read through that what is being done. If you can calculate in your Excel, you can do it. If you cannot calculate in the Excel, use the web calculator. Just visit our website, visit the calculator link. The first one, trend forecast using the natural constants. The first one you hit here. Just provide the opening price, annual volatility, calculate. So annual volatility, calculate. If you do not know how to calculate the annual volatility, below also we have given the link. So certain goods will not be having, or certain instruments will not be having the annual volatility. Utilize this particular tool, provide its past 10 days data. That also we have given. The latest data should be in the 10th place. Oldest data should be in the first place. So just provide and hit the calculate button, you will get the annual volatility. Put the annual volatility here, do this calculation. So this will give you a fantastic result in the intraday as well as positional trades. Test it for few days. If you are not convenient of making these calculations on Excel, do use the web calculator and follow it for a couple of days. You'll know the accuracy of this method. And this is one of the, you can say, our year 2021 innovations. However, the clues of this particular innovations was contributed by W.D. Gann, and this particular method we have first brought into the public domain in our last program, and it is being taken on the 17th and the 18th session, the last 1 month Gann program. Those who have joined this program, they have already knew this particular method, they are using it, they are highly successful in this. However, we thought more number of traders should know, and that is a practice of smart finance. Whenever we used to bring specific new concept, we not only restrict to certain paid webinarians, we brought this entire concept to the public, to the general traders, so that they can use it, they can feel it, they can experience it. So this is one of our new findings. If Tanji has told how to utilize it for positional trades. So positional trades, you cannot use the opening price. You have to use the closing price, 34,959. So 34,959, 34,959 back nifty closed. I want to use it for the position for the 4 days annual volatility. Just recently I have taken from the NSE side, though it is not the true annual volatility because it is taking past 365 days data. However, if I use here 36.90, 36.90, I can get the volatility, I can get the readings for the coming 4 days. 4 days. In fact, this volatility is not the actual annual volatility. The 365 days data are too old data to give you the actual projection. Now volatility is much lesser than 36.90. So how to use it for positional, that was only I have told here. Opening price you should not take, you should take the closing price of a day. You can use the number of days here, you can use the annual volatility as it is. Either you can take from NSE side, or better way will be to calculate it using this annual volatility calculator, using the past 10 days data, and use that annual volatility. You will get the exact or accurate results on this. Those who are the user of the software, I can just tell them here. So you need not have to change the style of your trading. Just to do the calculations as it is when you are doing for 10 days period, 4 days period. Suppose we are going to do for the Nifty 4 days period, Nifty for the coming 3 days period. Monday is gone, Tuesday, Wednesday, Thursday. 3 days we have. So if I am going for the Nifty 3 days period, so 3 days period Nifty, if I am going here, I am going to calculate here. So what happens? Once that calculations are done, I have to just hit here. I will get the levels for Nifty for the coming 3 days period. So in the software, you will get as per the real-time estimation of volatility. If you want, you can take a photo of this screen. So what are the levels we are expecting for the coming 3 days period? If you are going to do for intraday, as soon as market opens, wait for 5 minutes, because this system required 5-minute data for calculating the real-time volatility. 9:15 market opens, just wait for 9:20 period, just load the data, calculate and follow those levels. And here, as I told to you, trading process very important. Trading process is very, very important. Whether you use the manual tool or use this automated tool, this first three constants, first three levels are the consolidation band. So all buy should happen after the crossover of the first intraday top till the golden mean, 1.618 crossover. So this from 15,799 to 15,810, any price range you can buy. Once you are buying this, just watch out for any price range you can buy. Your stop loss should be 15,756 here. So here this will be the stop loss, and once this particular, you have to watch out for 15,838. If this price crossover happens within a few minutes, you can expect this hyper cycle crossover to happen, else price will fall back. So if very quickly within 5 or 10 minutes, if you are not getting the hyper cycle, you must think that trade is not going to be successful. It may trigger the stop loss. So these three are the consolidation band, and the most important factor is minor cycle, which is 15,838. Or you can follow a other tactic for this trade. Instead of buying at the top level here 15,799, once the price crosses 15,838, you can buy. 838 you can buy, and very quickest time you can get it at 15,893. So minor cycle top crossover you can buy. Take hyper cycle top as your target, and stop loss you can say, you can keep it as a first intraday bottom, or you can keep as first intraday top also. If you are, I will be convinced with the first intraday top should be the stop loss. So top should be stop loss. In fact, it is a positional analysis we have done. If intraday analysis you will do, the things will be different. The depth will not be that much. So intraday analysis you can see here. So very depth is not that much. You can keep 15,800 level, you can buy. The first you can expect 15,819. Once it crossover happens, you watch out for 15,824. The stop loss you can, and 837 crossover, it will take you to 856 with no time. Your stop loss will be 15,812. Once you are entering to the third cycle, second cycle, hyper cycle top will be your stop loss. So this method you can utilize. So those who are using the software, they can utilize this thing in a great way. I am using all natural constant based on their own essence. My first top having no natural constant in calculations. My second top is having square root of 2, which is 45-degree slope. So my third top is nothing but it is the Fibonacci 1.618 retracement level. My fourth minor cycle is using the square root of 10, and my hyper top, which is the last of any cycle, is using 2 pi r circumference or 360-degree rotations of a price cycle. Here my r is volatility, pi as it is, and 2 is a constant utilized in the 2 pi r formulae. So this all formulas I am using. So I'm suggesting you to make a purchase after this first intraday top, or these three are very critical levels. So I'll be suggesting you the 5 crossover gives a great hope for the hypercycle. Either you can enter here in the first level or the second level, first to third level, any price you can enter. So these levels, any price level you can enter here, but that won't give you that much of confirmations. But when the 5 crossover happens, 1.618 crossover happens, that will become a very important resistance and support. So that will give you the hope for the hyper cycle top to happen quickly, that too also very quickly. So if you enter the first three levels, it is good, or use for this 5 level crossover, 5 level crossover. So that is what I have told here. So the golden mean top, golden mean is 1.6, it is golden mean. So this crossover happens. So crossover happens, your confidence on hypercycle should increase, or you'll be more confident to achieve the hypercycle. So that also makes some sense to enter after golden mean crossover happens. And once again, I repeat, though the base or the thought or the very idea of using this particular natural constants in the trend forecast is given by W.D. Gann. So it is only spoken by him. So here the idea of using the natural universal constants in trend forecast is a contribution of W.D. Gann, who has mentioned or who has spoken about that. So we have taken these things forward, and with a prolonged year of research, we found out that how best we can utilize this constants for our trend forecast. So with the with the help of this natural constant volatility and the stock price prediction formulae already available using e to the power r into t. So we have just developed this model, and this is one of the 2021 new innovation of smart finance. Very simple method, and it is a very powerful method. So I'll request all of you to use it. So the associated calculators, so it's being given here. It requires only three inputs: opening price for intraday, annual volatility. For positional, you have to take the closing price for the day and the number of days you want to hold the position, and annual volatility. Only three inputs, and the readings will be valid for the entire day. So this is what I have told, and this particular concept is being programmed in our smart IT all-in-one tool. So those who are having this tool, please update your tool. You can get the access to this particular interface and start using it. And we have also scheduled one fantastic program for option strategy, which is going to happen from 9th August 2021, going to end on 13th September 2021. Very big long program. So 6 p.m. to 7 p.m. evening it is being scheduled. So if you are interested, registrations are open. You can register and join for this program. And this concept is one of the concepts taken in the last complete W.D. Gann's course, along with other subjects. Many new concepts are being covered in that program. So many of you have joined and take the benefit of that. So this is one of the thing. So other than that, many complex Gann subject is being discussed in that program. So if anyone has the interest, they can still buy the recordings along with all excels. So they can learn this program. If you have missed this program, you can still eligible to buy this program. Need to visit to the seminar link and need to visit that complete W.D. Gann section. So here you can view the topics of that program if you purchase. So here we have given how to purchase this program. So this is all about today's program, and hope you have enjoyed this program. And I have given the web calculator which we have released today on this particular concept. So take benefit of this particular tool. Start using as much as possible. It doesn't require any registration. Just visit the calculator link. The first tool new we have given, And if you do not know about the volatility of that instrument, use the second tool. So you can utilize these two tools and make excellent trend forecast. Thank you very much.